Good evening, everyone. Thank you for joining me this evening, for this Wednesday night teaching webinar. Tonight, we're going to be discussing Delta and how to adjust using Delta and so forth, because obviously we have a one-way market. It looks like at one point this week, the NASDAQ was up almost 500 points in just 3 days. Looks like right now we're going to have another up day. It seems like for some reason, once the Asian markets open up around 7 o'clock our time, our market jumps back up. We were pretty flat for a little bit, but right after 7, we jumped up again, and it looks like the Groundhog Day will continue. Some of you are doing awesome in this situation, which is great, and it's a few of us that are not doing so great, but we need just to hold on and keep that extrinsic working, and hopefully the market will slow down for us. It doesn't necessarily have to go down, but if it slows down, that would be great, because this week it's basically been going up at least 1% a day. I think on Monday was 1.5%, Tuesday was over 2%, today was 1%. Talking about the the ES, the NASDAQ was obviously not up 1% today, but at one point it was. It didn't end that way. We'll see how it does tomorrow. But the ES just hit its all-time high again today, and I don't know. You have certain companies coming out like Starbucks closing locations in China. You have Nike closing locations. You have Apple closing stores. You have Tesla saying that that their shipments are going to be delayed and things like that. But it does not. Nothing seems to stop the market from going up higher. I'm assuming it's because of more stimulus, and they feel like we're going to have a backstop because China put more stimulus. Eventually, that's going to come to an end. I don't know when it's going to come to an end, but I hope it doesn't end like it has in the past when you have irrational bubbles. It's a famous economist named Maynard Keynes who was quoted as saying, "The market can stay irrational longer than you can stay solvent." So that's a perfect example here why you have to understand your deltas so that you can keep adjusting the deltas and watching your buying power just in case the market continues to go in a direction that is against you. All right. So in this case, I wanted to point out a few things about delta that I've talked about in the past, but and then some things I haven't talked about. All right, so let's jump into this really quickly. So I'm just going to use this clear one here. Obviously, Delta measures two things. All right, so you've heard me talk about this before. Delta measures your directional risk, and it measures your probability of success. So when I'm talking about directional risk, I'm talking about 1 point move. It's based on a 1 point move, and as a Dorian Way trader, we beta weight everything to the S&P, the SPX here, the S&P 500. So if your deltas are negative, let's say negative 40, that means theoretically that every time the S&P moves up $1, you're going to lose $40. It's theoretical because you do have theta that offsets that directional move. But if you just wanted to say if all else was equal, if you have 40 short deltas and the SPX moves up 1 and you're beta weighted to it, then you're going to lose $40. When if you want to change that risk, then you have to change the deltas. Okay, so the delta measures your directional risk. So if you change that delta from 40, let's say, to anything less than 40, then you've changed your risk, at least for that moment. Obviously, the market moves quite a bit. So in this case, looking at this account, this ES is negative 24, almost negative 25. So if I wanted to reduce the directional risk of this account, I would look down all these different trades here, and then I would start with I would start with this ES here and try to figure out how I can reduce that risk if I wanted to reduce that directional risk of, and in this case, obviously the market going up. As the market going up, this account is going to get hurt more and more unless it slows down, right? So when when I'm looking at that, I could do a few different things. I can look at the positions and I can decide that, let's just go to some of these here. I can decide here, this is 16 days to go. I've already moved the call side, the short leg, and kept a long leg that's prayerfully won't be hit. But on the put side, the closest thing that I have is the 14 delta. So if I wanted to change the deltas here, I could take this put up and I can just do what is, what we call a roll up and move this put closer to at the money. And this is only a 15 point wide spread here, but let's just say I decided I can go as high as the 25 and I just make it um, I just make it 20 this 50, keep it 15 points wide here. So um, this is something that can give you some more deltas, but in this case, in this account right now, actually rolling this up is going to reduce the buying power. So I wouldn't want to do that in rolling this one up to reduce the deltas. If I went to the next column here and I looked at 30 days and I have two calls here at the 27 delta, I can look at that and go to the side over here, and I have no puts over here. So I could decide, okay, well, maybe that 20 delta is something that I want to adjust. I can do what we call the roll away, and let's say I roll this away, since it's not, move it to the 25, roll it away 5 points. Well, that's also going to cause some buying power there, because that's like adding something new, because when you are rolling away on the call side, you are actually adding long delta. When you're going up towards at the money, you are adding short delta. So if I wanted to add some long delta, I can do this roll away, but in this case, it's going to require some buying power, right? But let's just say I decided I was going to do this. It's going to only be $33 based on what this is for, or $34. I could add something to the non-tested side to be able to do that, and I can do it at let's say the 12 delta here, and let's just do it 30 points to be able to get that $30 back, right? Well, I can do that, but once again, this is going to require some buying power. So I can decide to do it or not based on how the buying power is. But that's in this case, I'd say we're not going to do it. So we can go to the next one here, which is 37 days. And you can see right here that I put on a butterfly hedge, and I put this on at the 30 delta. And you can see now it's already in the money, this part of the butterfly. So that is how much this market has went up very, very quickly. And I put this butterfly on less than, maybe I put this on Thursday. I don't remember exactly, but it was after Wednesday, because last week we went over the butterfly in the webinar. So I put this on last Wednesday, and it's already at the 50, 52, 53 delta. So that's how much the market is moving up, right? So I just, on that side, I just have the butterfly. And then at that same time, I didn't know which direction the market was going to go. So I also added a butterfly here, and adding the butterfly there is did not, I tried to put that closer to at the money. It was probably around the 40 or something like that. So that's actually changed. But as you can tell, the market has went up quite a bit this week, but we haven't experienced that in the puts as much. We should have lost a lot more premium in the puts, but the volatility is staying there. The market keeps going up, but we're still over 15. Right? The futures is over 15 right now. That /VX, we might we might stay over 15 tomorrow, especially if we go down, because most people are thinking that this is irrational, but it seems like the least resistance is to the upside. So we just have to keep trying to adjust. With that said, you can see I'm trying to show you this account here. We have 43 days to go, and then now you see that I have something here at the 44, and I want to roll out at 45 because I've already rolled this before. So if we rolled out something before, then we can wait until the 45. So that's basically here now. I'm trying to hold off just a second, see if we have a pullback tomorrow, since we've went up so much on the ES this week. Obviously, it's not showing that right now, but if you were watching the market this morning, you would think the NASDAQ was going to be up over 1% as well, because it was at one point. But right in the bell opened, the market, the NASDAQ went all the way down. It actually went red for a while. So we could see that type of volatility really quickly when it starts to go down. I mean, Tesla today went down 17%. That's to me the icon of this bubble, and not that it won't go back up tomorrow, because people might think it's a buying opportunity. I think I wouldn't be surprised to see Tesla down 500 points, right? But when the fever resides, when it goes away, then we'll probably see a lot of people crying. I'm going to be on the side of only way you can carry me out is if I'm on the long side, meaning that the only way you're going to hurt me to the point where I can't trade anymore is if it goes down a lot and volatility increases quite a bit, right? But if I have short delta, then I'm going to withstand that. I'm actually going to benefit from it. So that is what I'm thinking in this account. If I have to roll this out into another 30-day period or whatever the case may be, I will do it to win. And looking at this, let's just look at this here. If I tried to move this, right? If I tried to move this now, because once again, reducing your deltas is going to reduce your risk, right? So if I wanted to reduce the long delta once again, let's say I tried to move this 10 points, and this is just the full roll away 10 points. Actually, that's a little bit more than 10 points. Let me go right here. All right, so now that's 10 points. You can see some of these strikes are changed. This might not even be a correct strike, because that 5-point wide there doesn't make sense. All right, so anyway, sometimes the exchanges send the brokers the wrong strikes, believe it or not. I just realized that about a month ago, mentoring someone. It happened a couple of times. So anyway, if I do this and move this, it's going to reduce the deltas, but it's still going to require some buying power. So if I wanted to figure out how much the deltas are going to be reduced, what I can do, let me show you this here, just a ballpark figure. Let's just say I wanted to add another contract here at this 15, right? So you go to this 15, and the 15 delta is 12. So that's 3. 15 minus 12 is 3, and you divide that by 2 because the ES is half the size of the SPX. So you divide it by 2. Always divide your deltas by 2. So this is going to give me basically 1.5 long delta if I put this on. So this will change the delta a little bit if I do that. So once again, so you can understand a ballpark figure, you take the short leg and you subtract the long leg from that. That is 3. 15 minus 12 is 3. You divide it by 2, that's 1.5. If you were on the call side, you would do the same thing, but you would be getting short delta. Okay, in this case, we were getting long delta. If you're on the call side, you were getting short delta. So it's kind of a way to figure out how your deltas are going to change. It's not exact, but it's pretty close to exact how your deltas will change. All right, so if I add this, right, if I add this contract, you can tell when I was looking at the 16-day, I think the 20-something day, the 30-something day, now I'm looking at the 40-day, right? If I add this on the 40-day, it's finally going to give me a credit to do it, right? So it's I'm playing with the span margin. I've been trading this for a long time, so you might just by going to a different expiration period, you can perhaps get the type of ideal type of trade you want. So if I wanted to reduce the deltas on this account, I could. In this case, I'm not going to do that tonight because I'm wanting to see how tomorrow plays out. Um, Let me move on and point out a couple of things. One of the things I wanted to say to you, if you put on something like this, let's say we did, right? And we put this on and we received $168. I don't know why that is saying that. Let's see. That changed quite a bit. It was positive. Now it's negative delta. This whole account thing is all off. So some of this stuff is off during the futures tonight, I guess, because this was just showing me a positive 77, then it just quickly changed. But anyway, let's just say we received this and you received $100 and you wanted to offset your deltas more. You had you received some long delta here. What you can do is also go into take that $100 and you can buy a call spread at the 30 delta to offset some of your risks. So let's just say this is the 30 delta here. This is not clean, but let me just show you here. Let's just move it down to this 25 so it can be clean here. If I bought this call spread, this will give me delta. Obviously this call spread is going to be 138, so I wouldn't actually buy that too much, right? So what I could do is do what I was talking about last week, is buying a butterfly, right? So I can sell this butterfly and buy here. This is 20 points wide and this is 10 points wide, so you'll be able to make some profit on. Let me highlight this here and sell another one. So if I sell this is actually expensive too. This call side is very elevated, right? So you can go into the SPY to try to get some long delta if you needed some. In this case, we're around that 43 days. So I put this 40. This is going to be 43 tomorrow. It's not showing that yet. But if I wanted to go here, I can go to this 30 delta, buy that. Let's say sell 3 points lower and then buy this. So we're going to do a two contracts for the butterfly here. So when you're doing the butterfly, it's 2 in the middle, 1 and 1, and this right here is going to be $75. So if I received 105, I can get some more long delta and have a hedge as much as 225 on the upside. So you're getting long delta in two different ways. You sold the put spread, got some long deltas, and bought a call spread, or in this case, we're buying a butterfly to be able to get some long delta if you needed that. And the way you want to look at this, and this is another things I wanted to point out tonight, because I realize some of us is not aware of how this works, right? So for example, this right here is long until here. Okay, this is long until here. And each point on this SPY equals $100. So if we bought a call spread and it was 3 points wide, the max we can make before fees and commissions is $300. If we sold a call spread that is 1 point wide, that means the most we can lose on that call spread we sold was 100. So if you can make 300 on the long leg and lose 100 on the short here, then the max you can still make $200 even if it goes past there. This is the type of hedge with this butterfly. It's pretty powerful. You can still make 200. Your max is obviously this here, but you can still make 200 if it goes past it. Okay, and this is not including fees and commissions. Obviously, it'll be a little less than that for fees and commissions. Your max win obviously is right here though. All right, so with that said, I wanted to also point out how to calculate
Quick
the,
question. Oh,
yes.
Brian, this is Keelan talking. Thank you for going over the butterfly a little bit more, because I have been confused.
Okay.
Appreciate that. And so I'm trying to connect the
That
butterfly
was
to
a
a
broken
trade,
wing butterfly, by the way, but go ahead.
broken wing butterfly to a trade that I already know. And so it looks like you have you have a call spread, and then at the bottom of the butterfly you had you sold another call, but then you bought a call underneath it. That was a
Correct, correct. Let me
still
let me
trying to
let me
understand it.
show
It's
you.
like an iron corridor all on the same side and kind of put
Yeah,
together.
let me show you that again really quickly for because maybe someone else has a question on that. All right, so let's just say this
At
is
the
the
30
butterfly right
delta.
here, right? This is the butterfly. A
Mm-hmm.
butterfly equals a call spread, a long call spread. On this case, on the call side here, we're on the call side.
A long
So it's a
call.
long call spread, and then it's a short call spread, right? So this is the first part. It looks like this. The second part looks like this. All right. This is a broken wing one. So
Mm-hmm.
this is the second part. It looks like this. This is the short leg. All right. So that's
Mm-hmm.
why in the middle here, you have two of these. Right.
Okay.
So then when it's all said and done, it looks like this. Okay.
Mm-hmm.
So one, you have your one here, and then one there, and then you have your two here.
Okay.
And then this is a broken wing one, and because it's a broken wing one, it allows you, if you using this as a hedge, it allows you to make money regardless if it goes all the way through. If you
Mm-hmm.
were using a traditional one, the whiffs of the spread, the whiffs of the strikes are the same, so you wouldn't make any money if it went all the way through your long leg here. Okay.
Mm-hmm.
But in this case, since it's a broken wing butterfly, you're going to make money if it goes through your long one, and you're going to make money if it obviously stays between, if it stays between this here, right? You're going to make money. If it's up here, you're not going to make any
Lose
money.
money, but that's the hedge. Okay.
Correct. That's the hedge. So, and this is just another way of doubling up, right? So let's say you had a lot of short delta and you sold a put spread, or you rolled up your puts and you got more money than you needed. So you decide, okay, I'm going to double up on my long delta just to hedge the call side a little bit more. You can buy a butterfly here. You can also do a put spread, but obviously doing a butterfly is a little bit more powerful and it could be a little bit cheaper. And or if you had a lot of monies, right? Let's say you got a lot of monies that you received, you can decide. Let's say you received at least 250 or whatever, right? Well, you can buy just the a single call, right? So if you
Hmm.
buy a single call, obviously that's going to offset your deltas as well, and you're gonna go that way. So, but because the S&P is 10 times the SPX is 10 times bigger than the SPY, you're going to have, if you wanted that delta of 31, you wouldn't divide that by 2, you would divide that by 10,
Oh,
and then that would is it's going to give you um, about 3 long delta. So that would offset you a little bit there. So
okay.
once again, if you're doing the ES or the RTY or the NQ, your rough estimate is dividing it by 2, whatever your delta number is, if you wanted to understand how much you were going to receive delta wise. If you're doing the SPY, you're going to have to divide that by 10 because it's 10 the SPX is 10 times the size of the SPY.
Okay.
Okay.
Thank you.
All right. You are very welcome, Keelan. Great question. All right. So, um,
I got a
when,
I got a point to point out if I can.
okay.
Okay, on that butterfly you had,
Hmm.
you wouldn't make any money if it passed up that second that last leg. It would just lose the money that you had in it, wouldn't you? Because the 40s
No,
would be went to 145 or 345. The 40s would be worth $5. The 43s would be worth $2 each. That'll be
all
four
right. So,
dollars. And
so, so
then
let's break it up again, right? So
okay,
this right here, this is a broken wing one, right? So
yeah.
this,
And you have
this
two.
I have, and then I'm going here, right? And then I'm
Yeah.
going. So for that just break it down, right? That just break it in half so you
Okay.
can see what I'm saying. So if I
Okay.
sold this by itself, this call spread, right? If I sold it by
Yes.
itself, how much can I make? max?
You can make $3.
My max I can make is $3, correct?
Yeah, that's correct.
All right. So after fees, the max I can make is 200 because this is this is $1 right now based on what
Yeah,
this
yeah,
you're saying
okay.
right now. Okay.
Yeah.
So and then if I now put on this one, right? This is a separate. Let's just look at it separately, right? If I put this one on, right? How much can I? What's the max I can lose on this?
$1 minus the credit.
The max I can lose on this is what? It's a $1, correct? Minus the credit, minus the credit. So
Yeah.
let's just say the max I can lose is a 74 here, or even 100, right? Because we were saying 300. We're going to do this without fees. The max I
Yeah.
can lose on this is 100. The max I can make on the broken wing part on this part here is 300, right? So if it goes all the way through this, how much would I still make?
Okay, let's say if it went to 45, for instance, right? The 40s would be worth $5. The 43s, you have two of them. They both would be worth $2 each.
So
So that's
you're counting. It stops. It all stops. If it goes to the 45, everything stops and it stays it stays based in this range. It stays based in this range. Okay, because
okay.
what you're saying, it's Robert, right?
Yeah.
Okay, yeah. What you're saying, Robert, if I had just this on and it went to the 45, right? Then you're saying I would lose instead of 100, I would lose 200, right? But no, it stops. Your max loss stops here,
Yeah.
right? And then because I have this long leg here, it's no way my max gain and my max gain stops here because I have this long leg. So even if it went all the way down here and I didn't have this, let me just change this again. Even if it went all the way down here, right? My max gain would still just be in between here, right? So that's what I'm saying is that your max gain on your long leg is 300. Your max loss on your short leg is only 200. So this is a broken wing one. When you're doing a regular um, butterfly, then you're correct. If it goes to your short leg, you're just going to break. It's just going to break even.
Yeah,
So
you
for
lose your
example, correct. So that's for example, if I did this equally wide, right? So this is 2 points wide, and then this one right here is 2 points wide, right? So what happens here is that I can make 200 from here to there, but then if it goes all the way to here to the 44, I lose another 200. So then it just
yeah.
breaks even. That's the traditional one. That's the one. That's the one you're talking about. And you're correct
Yes.
on that. But when you break it up, when you change it up like this, if I go like this, let me just make sure I put 2 here. If I go like this, then I can make more this way to here and lose less this way because it's broken wing. When broken wing means it's not equal distance between each leg. So I
Yeah,
hope
yeah. I
that
mean, I know that.
okay. I
All
hope that
right.
helps a little bit. You had to
I'm
study that one a little bit.
yeah, yeah. Okay.
That's what makes
All
the
right.
broken. That's what makes the broken wing pretty powerful. Um,
Okay.
but also just think about it like I just said. Think about it as two separate trades, and then how much can you lose or make on each trade, and then that's how you can determine what I'm saying here. Anyone
Okay.
else? Anyone else got questions on that butterfly for a hedge? I know that wasn't this is not the topic I wanted to talk about tonight, but like I said, it's always open, and you can interrupt me at any time and present and ask any question and so forth. Um, but I just wanted to make sure you understand how you can double up your deltas, how you can change your deltas. So for example, if you sell a put spread, you could buy a butterfly that would also give you some long delta, and that would offset things, right? Another way you can get some long delta if you need it, and you see that I have it in this account already, and this is the I have an ES in here, and this is a short delta, right? And I've been getting actually murdered on this, but I don't want to take it off because I'm afraid that the market is eventually going to go down, right? So I got that short. This is a micro future. So if I decided that I wanted some long delta, right, I can buy this micro future back. But if I take this off, this is going to reduce my delta. So it's another reason I don't want to take it off, right? Even though these deltas in this account is very, very high, if I went inside it to say, okay, what happens if I buy a NASDAQ M future, right? And I bought it, and I'm looking at this here, and I click on the ask to buy. That is not going to be a lot of buying power, but it is some buying power, right? So if I go to the M2K, this is the Russell, this weird symbol, but this is the Russell. If I buy this back, if I buy this one, this is going to give $47 in buying power, but I don't need to do that, right? And it's offsetting this short one that I have already here. So that is just take it off. I rather keep it on, and because what's going to happen is that you want to, when you've been losing, right, in a certain direction, you don't want to change your deltas too much. So this is why I'm showing you how to change your deltas and how to calculate it, but you don't want to change it too much so that if the market goes back the other direction, you actually benefit from it. So I'm keeping this account very short, so that when it does go down, I'm going to benefit from it. And hopefully, and usually in the past, you benefit just as much as you've lost, if not more, from the upside move. So in this case, I'm waiting for that move. But if it doesn't happen, I'm going to stay within a range, right? So let's say the deltas are I want to stay in the range of plus or minus 50. Well, I'm going to stay in that range so that if it won't get too out of hand on the delta side. And you can do that by a number of ways that we talk about in lesson 4. And then just to give you a little recap, you can roll up, obviously, you can roll away, you can roll out, and that's the last type of resort you want to do. But you can if you can, you can add a new position if it doesn't require any buying power and not going to put too much risk on the non-tested side. And then you can take some of that, what I just showed right now, and buy a call spread or buy a butterfly to double up on your positions. Or you can do some stuff like this, right? Sometimes you have to sacrifice some of your premium, and I talk about that in lesson 4 as well. Let's say you have a bunch of premium that, even if you sacrifice some, if you can get the majority of that back, 68%, 75%, you're still going to get back to even or be up. Then you could sacrifice some of the premium. So for example, if I went to this ES here, and let me show you some stuff that I did today, if I can show you this. All right, so that is a credit. This is a debit to buy back. This is, all right, so that's a Russell. All right, that was a roll away. Let me see, this is trying to see what was the ES here. All right, let's see what this is, if I can show you what this was. Hold on a second, similar order. That's not showing. Anyway, let me just go into what I was going to show you. I can't, it's not as easy to look for it on the TastyWorks platform. But what you can do sometime, right? Instead of, especially because TastyWorks doesn't allow you to do some things in concert. I know some of us has been able to do a roll away or a roll up in concert from time to time, but it's not consistent. And you wanted to change your deltas a little bit, and you wanted to do it and get some buying power or whatever, you can do just a partial and sacrifice some of your capital. So if I move this right here, these two, then I'm reducing the risk by doing a partial rollover but not financing it. So instead of being 20 points wide here, I'm only going to be 15 points wide. So that's reducing the delta and the width of the spread, as you learned in lesson 7. And then I can do this right here for a credit, right? and this is not going to be too much to do it. It's only 183. So if you have thousands of dollars in extrinsic, you can sacrifice some of this, right? You can also, if you needed to, you can do that type of concept on the put side as well if you needed to get some, get some buying power in the put side. Was the side that was causing the problem, right? You can also decide, well, I don't want to do it that way. I can roll it away, and it can, do the same kind of thing and probably be a little cheaper to do what we just did right here, right? But this is actually rolling it away. It's actually reducing the buying power. I mean, it's reducing the buying power. So the partial roll away was actually the kind of concept that will work here. So that is a way you can change your deltas. Sometime you can change your deltas by going into something else, even though in this case maybe you've adjusted a lot in here and it's hard to get things to work for you. So for example, you saw me putting on put spreads. It was not working, even though this was really, really short. So maybe you go into something else, right? So let's look for the NQ here. Maybe you go into this NQ. There's 43 days to go. Let's just see what happens if I sell the 7 delta here and see what it does to me. And just to sell the 7 delta 100 points wide, normally it's 200 points wide, but I just want to see what this will look like. So we're going to sell this 100 points wide, and by doing this is going to give me a little credit, right? So if I was doing a put spread, if I was adding something on the ES, even though it's very, very short, it was going to increase the buying power. So sometimes you have to manipulate the span margin. Is thinking there's a little bit more risk in that ES, so it's less risk in this. So I just actually put on 2, and the buying power is increasing here. So that is a way you can do it as well. Another thing that you can do to reduce your risk and get buying power, I just say you can start taking off positions that you have winners on, right? And that can help with your buying power. So in this case, I have a little bit of a winner here on this put side, right? But if I did that, it's not going to help with the buying power. But if it did, I can take that off, right? I'm looking at this call side here. That's not going to, it'll help with buying power if I took it off, but it's not a winner, right? So, but this will help the buying power quite a bit. But I just say that's going to cost a little bit to take off, right? So 363, maybe that's insignificant if you have a lot of extrinsic, but if you don't have a lot, let me find that position here. Excuse me. Come on. All right, so this is the 30-day, I believe. Let's see, maybe it's 16. All right, so 16, there we go. So we can do something like I just showed here a second ago and reduce the risk by reducing the width of the spread by doing that roll away. But that's gonna be cheaper, but it'll give you some buying power there if you needed it. So that is a way you can do it. And so obviously this is weird. This is one of those things, like for example, if I take off these 2 calls here with 30 days to go and try to reduce the risk, if I take those off, you see how I'm really, really long, really, really short in this ES. But if I take these off, these 2 off, it's still going to decrease my buying power, right? So if I try to just take off 1, see what happens, right? So I can take off 1 and it increase it, but it's not going to decrease it if I take off both. So I need this market in this account to go down, or it's going to have to continue to adjust. But this is some ideas on how you can see what to do to adjust your deltas. Let me just make sure that I'm covering everything. All right. So that is all I wanted to point out on how you can adjust and kind of change your deltas. It's important to understand that if your deltas are too much in either direction, if you change it even by 1 delta, you are decreasing your risk, because delta is that directional risk. right? So just rolling up is going to decrease your risk, or rolling away is going to decrease your risk. Is whenever you think about reducing your risk, just think about it in deltas. And if you're afraid of something, you can decide, okay, I'm going to change my deltas by 25%, or I'm going to change my deltas by half, or I'm going to change my deltas by 10%. You are reducing your risk by that amount at that time. That doesn't mean it's going to stay that way, because obviously delta changes, right? But at that time, you're reducing your risk. All right, so any other questions before we conclude tonight? Any questions about this? Any questions about anything? Any questions about your account?
Hi, Dorian.
Yes.
Yeah. Hi. This is Tariq.
Hey, Tyreek, good to hear from you tonight.
Yeah. Hey, I was wondering, do you have any strategies, or do you ever consider trying to adjust Vega, or reduce Vega? Because I noticed in your ES position that the Vega is really large, 365. Do you ever consider that, or do you just focus on trying to manage Delta?
So I focus on focus on Vega. I don't necessarily consider that too large, but I do focus on Vega as well. But Vega will change based on your delta risk. If you change your delta risk, your Vega is going to change. If you're a net seller, that Vega is going to be a net. It's going to be a negative amount. So Vega measures how much you can make or lose based on a 1% increase in volatility, right? So if this volatility right here increases by and it's not necessarily these, but it's the S&P, the ES volatility. Let's say it was 15. If it goes to 16, this is theoretically how much this is going to change. It's going to change by 365. Um, so if I have short delta and I change that, then I'm going to automatically change this situation as well. Um, but if my theta is offsetting some things as
Okay.
well also, so it's not all one to one. But I do look at that, right? But if you're a net option seller, you're going to have you're going to have short Vega, and you can determine what can happen if to your account to some degree if the volatility increases. But if volatility decreases, right, then obviously that would be a positive for this account as well. So volatility can decrease even if nothing happens, right? Let's just say the market tomorrow is just flat all day. Well, volatility can decrease, and I can actually make money based on that theta and so forth. Because of Vega risk, you want to offset that risk um, by your delta, okay? And having 1 to 2% short delta based on your Vega, you can offset that, right? So if volatility increases, what's happening? The market is usually going down. Almost 100% of the time, the market is going down if Vega increases. This is telling me that I'm going to lose $365 if volatility increases, right? But if volatility increases, it means the market is going down. And what is this telling me, right? This is telling me if the market goes down, this is actually going to benefit me. Because I have so much short delta, it's going to offset this Vega change, and I'm actually going to win because this delta is going to be more powerful than that Vega, right? So for example, I tell you you should have 1 to 2% of Vega. Or delta based on Vega, right? So if I go 24 divided by 365, I have 6.5% delta based on that Vega, right? So I have way more than I normally want to have, about 2% to be able to offset the down move. I have 6.5% of short delta based on Vega. And I know that's confusing. So if you don't understand what I'm saying, please interrupt me. But because Tyreek, because I have short delta, I'm not afraid of the Vega, because Vega only hurts you when volatility expands, it increases, right? Well, my short delta helps me with that. So it's all offsetting. And then also, obviously theta is helping me due to time decay. But currently I have enough delta, short delta, to help the volatility increase. So that's why I'm not really worried about it, Tyreek.
Okay, thanks.
You're welcome. Um, so any questions on that right there? Because it's important to understand. I know we don't talk about Vega a lot. I do in course 2, and I want you, and when you go over it with me, I want you to completely understand it, because it's another just a way of just a comprehensive understanding of what your account is doing, right? And how to manage yourself. So I'm always worried about the downside. So in the past, you probably heard me I don't care about hedging the upside and so forth. And it seems foolish over the last 5 months because we've been going up so much. But I'm still not going to get carried out on the upside. It can keep going up, and I'm just going to keep adjusting. But if it was going down as much as as much as it's been going up, let's say it's been going down for 5 months, and we were having 1%, 0.5% days all the time down. It would be brutal. Everybody would call in the world to coming to an end type of thing, right? If I don't know how many people remember 2008. I know it's a long time ago. It seems we haven't had a really down year since. Just maybe 2 since then. I can only think of one that we've had, and that was 2018. The other one was flat. I think that was 2016 or something like that. Anyway, any other questions this evening?
Oh, Ryan, I have a question. This is Herman.
Okay.
So I'm not sure whether I'm hearing correctly. So my overall delta is negative. I think a lot of people's overall deltas are probably negative right now, but it's not too negative. Does that mean that I don't necessarily have to immediately roll out if my positions hit 45 delta? Like I can hold it a little bit longer.
So that's a good question, Herman. You want to manage it on an overall portfolio and an individual position. So because you don't want your individual position to take over the portfolio, and that could happen as option sellers, right? So you want to check and see how much can you hold. Let's say you wanted to hold your position to go in the money a little bit, right? So thank you for pointing out, Herman. I'm going to show you something here. So let's just say you had a spread on that was right here, right? You had a spread on, and let's just say it was, let me move this out of the way here. All right. Let's say that you had this spread on and it was 50 points wide. So there's 3350, 3400, okay? 50 points wide. So the ES is $50 a point. Okay, so traditionally you learn from stock, it's $100 a point, right? Well, the ES is $50 a point. So if you had max loss here, it would be 50 times 50, right? So there'd be $2,500 would be max loss here, right? So let's just say you had more premium than what you can lose on that spread, right? So maybe you want to hold it a little longer, or maybe you want to hold it until it gets to the 3370 or something like that, because it's the max you can lose on that. Each contract is 2,500 if it's a 50 point wide on the call side, and that's mostly what the Dorian Way is 50 point wide on the call side, right? So you can hold it longer, Herman, if you wanted to. But this will obviously make you more short as it goes through this, as it gets to your long leg here. But this is, you want to understand how much you can hold. So let's just say you in your ES, the most you can lose on let's say you had a spread on and you had 5 here. Just for example, Herman, you had 5 there. So you had 2,500 times 5. So you can lose 12,500. But let's just say your whole ES position, you had 20,000, right? So you can make 20,000 and lose 12,000 on, or 12,500 on this spread. Well, you can still make 10,000, 10,500, right? So why not do that? If that makes sense. Okay. So to answer your question, you can hold it longer, but if you want to kind of figure out what your risk is by holding it longer, just think about it by 50 points of spread and then times that by your $50 a point times the spread width times how many contracts you have. So if you had one contract, this would be 2,500. If you had two contracts, it's going to be 5,000 that you can lose on this spread if it goes all the way through the spread. And the way this market has been moving, obviously, it's a strong probability. I know for you, Herman, you've been rolling something for 4 to 5 months, but you've been still winning during that time, which is awesome, and you know you can still do it. But if you're tired of rolling, and don't get tired though, but if you are, you can hold it a little longer and see if we get a pushback, because this week it's been brutal, but it doesn't mean it can't continue for a while, right? It's been going on for 5 months now, so this week is probably one of the worst up weeks in that 5 months, but that doesn't mean it can't continue. And we'll see though. All right, so did that answer your question, Herman?
Yeah, thanks.
You're welcome. So Herman, one more thing is that let's say you can look at that Vega, right? Your beta weighted Vega on your Thinkorswim platform, then you can divide that into your short delta. So let's say you have short delta of your negative Vega is 100 and you have short delta of 2. Or let's say you have short delta of 20 and you have negative 100 Vega. So you just divide that. You just take that 20 and divide it by 100, and you'll get 20%. You have 20% of your you have 20% of negative delta based on your Vega, and that's higher than what I even showed a second ago of 6.5%. So you want to be 1 to 2% to be able to offset the down move, at least the initial down move, obviously, right? Because you can't, if you just like some of you realized recently, you might have one call spread 50 points wide, everything else is put spreads, but the market has been going up so much that one call spread is damaging your account, right? So that is how powerful this move has been. So if we were going down and we continue to go down, you're going to get long, right? You can go from short to long pretty quickly depending on how powerful or how big the move is, right? So, and we sell both sides. We usually sell the put side more than the call side, but just selling one or a few contracts, it's been painful on the call side because that's all it's been doing. And then when we get a down move, we get a down move that's violent, like it was last Friday, that was over 2% down, and volatility spiked quite a bit, and you didn't really benefit from it as much because the volatility increased so much. And then next on Friday, Monday, it was back the other direction. So that's that's a little frustrating, but that's trading. You're going to go through periods like this. But if you continue to keep your extrinsic and keep your deltas in line and keep just adjusting, you're going to win over time. The market will slow down. It will allow you to win. And Herman's a good example of that. He's been fighting the call side a lot, but he still has been winning because his other positions have been outpacing or the negative drag that those call positions have been causing. Okay, so that's one of the beautiful things about options, is that you can be directionally wrong and still win, right? Sometimes you can let something get out of control, and then you're gonna have to start sacrificing some stuff. And I've been there, done that, and so that's why it's on lesson 4 of, okay, sometimes the market is just going to win, so you're going to sacrifice a little of the premium that you could make to be able to put things back in line. All right, so any other questions before we conclude tonight?
This is
Keelan?
Yeah, question regarding what you just what you just explained about Herman, and just a little bit more understanding. So even though the call side has been getting close to tested, I'm assuming he's not allowing it to get really past a 30 delta or 34 delta is a word, and he's starting to roll up.
You know, so
Are you saying
he's not allowing it to go in the money, but
right? Oh, okay. Because
he's been at the 45 delta, I believe. Correct me if I'm wrong, Herman, but he's been at the 45 delta before, but he's just not allowing it to go in the money, and then he's rolling out once it just can't roll away anymore. Put too much pressure on the put side, potentially put too much pressure. Obviously, in hindsight, it would have never almost never put pressure on the put side. Um, but it's just rolling out at that point, and then when he rolls out, he's usually able to get enough to do what he needs, and then it starts over again, right? So the market continues to go up, he's continuing to try to roll away, and then eventually he has to roll out again. Um, but his other positions are winning, right? So he's winning on that put side, he's winning on the puts that he rolls up, winning on some other positions. So that is
That's what
the
I was asking. Okay.
yeah.
Yeah, that makes
So
sense if he has the puts. If he's constantly making the puts because his calls are wrong, well, he knows his puts are going to be right, and so
correct,
one of those
correct,
sides could be winning. I don't know.
correct.
And,
And then
and
sometimes
Mhm.
you can win a percentage of the call side, right? So let's just say he's rolling out, but instead of making 75%, maybe he's up 20% on the call, right? But he doesn't want to just take it off, so he rolls it again, right? So
Mhm.
it's that kind of stuff happens as well. It's not just always completely lost on that call side that you rolled out.
Okay.
That was actually a very good point because like right now I'm sitting on 45 delta and I'm
Mhm.
thinking about rolling it out again on the call side. But at one point, I was making I wasn't really of course not recovering 100% back of my losses from previous months, but then I might get like 35% to 40% back, and then perhaps at that point we could also consider rolling out at that point. You know,
Hmm.
Mhm.
I don't know. I mean, what's your comments on this, O'Brien?
I think that is key. I mean, that's awesome. You can, especially if let's say you're within the 15 days and you don't want to get that gamma risk, right? You want that rate of change of delta is too fast. So you have 20%, 40% profit, but you don't have all that you want and you still want to stay in the trade. So instead of just taking it off, you roll it and extend the duration a little longer and try to get some more out of it. And a lot of times it might help you anyway. If you take it off, maybe your deltas change too much. So you take it off, roll it to the next month, and it keeps your deltas in the range that you want to be in. Because maybe you want to be a little short right now because you feel like the market is overdone, right? Um, it'd be, in hindsight, if I knew the market was going to go up like this for 5 months, I would have bought nothing but future contracts and held it, right? And made a lot of money doing that. But
Mhm.
if trading was that easy, then everyone would do it, right?
Mhm.
But anyway, that's the key. He's not losing completely every time on that call side. Maybe he's only made 10% of what he wrote out,
Mhm.
what he received and he wrote out. Maybe he's making 40% or something like that. But he's continuing to roll out and trying to take it off at one point at 75% or whatever the case may be, right? But he hasn't actually been able to do that yet. Or if he has, he didn't take it off at that point because he wanted more, and that happens too, right?
Okay.
All right. So, any other questions before we conclude? I know we got about a minute left, but like I said last time, I love this. If I want to make sure everybody is good. I know that um, a lot of you are doing well with this move, right? But if it continues to go up, you're going to even get short, right? And even if you're doing well with the move, you looking at it and you're thinking, okay, well, this is crazy anyway. I like that my account is going up, but maybe this is overdone. And if you're short, just be if you haven't did well for January or you have lost all your gains from January here in February, um, just hold on, you'll get it back. Just keep your deltas going and you'll recover it. I know actually, I know it's a few people that was down in January that's got it all back in March already. Excuse me, February. So it all depends on which positions you have on. If you have obviously a lot more puts on and you only have a few calls, you've been able to easily adjust those and still make money. If you had too many calls on, then it's been a little bit more painful. All right, so I appreciate everyone joining this evening. I'm going to send out this recording. If you have any questions after you review this, then let me know. The key to learning this stuff, you guys, is not just doing the one-on-ones. It's studying outside of it, participating in these classroom style meetings, and then studying, because you might once you go over it again, you might have some different questions that would actually help you understand the whole thing more. So don't just file this away. Look at these things again, because it might help. Okay, I know when I was learning the trade, I was a sponge. I wanted to get all the books I possibly can, and most of the books I bought was useless, instead of maybe one or two nuggets in it, and that stayed with me. And maybe these videos, most of this video stuff is useless, but maybe something you'll get out of it. So that said, thank you again. I will check in with everyone in the morning.